The JSE struggled to hold its own yesterday, even with news from local government of a further easing of some economic clusters. Today, the local bourse faces a mixed bag at the back of news of a partial COVID-19 lockdown in Beijing, a clash on the India-China border, and concerns of escalation of the US-China trade war. To give us a sense of how the markets open this morning, we're joined now by Petri Redelinghuys, trader and founder at Herenya Capital Advisors. Good morning to you. Thank you for your time this morning. How are the markets looking in early trade?
Good morning, and thank you very much for having me. Apologies for the casual look. We're still in the work from home kind of situation. But markets are looking somewhat firmer today. The top 40 index up around 1% so far, with mostly sort of green shoots around. Most of the market, most of the board is in the green at the moment. So it feels as if a little bit of confidence returning into markets. It's a strange day, or it's been a very strange time, really, more than a strange day. Given all the COVID worries and the economic impact that that's had, we've obviously seen markets fall very sharply on that, and subsequently have recovered most of the losses that it's made. And we're now seeing, continued sort of efforts from central banks around the world to continue to provide further measures of stimulus or quantitative easing. There were some announcements earlier this week that the Fed will continue to buy and stand by their toolkit that they have to support markets, and will actually start buying individual company bonds rather than just sort of government bonds. They've already moved to start buying bond ETFs, and now they're buying individual bonds as well. So that's quite a strong signal from markets. We didn't have the strongest session in the US over the last couple of days, but this morning we actually saw some news from China saying that they are intent on increasing purchases of agricultural goods from the US, which does put at ease some of the fears that had built around the possibility of the trade deal that had been negotiated up to this point basically falling apart. So that trade deal seems to be secure, and markets seem to be reacting relatively positively to that. So we have a relatively strong sort of start to the day today. We're outperforming the rest of the world as such, but the UK market's up around 0.4%, Germany likewise, and South Africa obviously up a bit stronger than that. I think as that sort of risk-on sentiment comes back, the emerging markets tend to benefit a bit more than what the emerging markets do. So we're a bit stronger today, which is great. It's a nice way to end the week, I suppose.
And are there any major moves happening on the commodity side? I mean, we see that gold is marginally stronger.
So it is marginally stronger, but it hasn't really moved all that much in the last couple of sessions. I mean, it's still floating around this $1,730 level. So even though it is up a little bit today, it's not, over the last couple of weeks, it hasn't really had a very, very strong surge. It's been sort of ranging between, what is this level, 1,680 and 1,050. So until we get above $1,750 an ounce, I think we'll be relatively range bound. I think that if we do see a break above 1,750, we could see some, considerable strength off the back of that. But until then, as markets stay confident and calm, I doubt we'll see gold breaking higher. I think gold breaking above 1,750 would probably be a signal that we're in some turbulent times.
As we take a look at the oil prices, they seem rather stable despite the rise in the US crude stockpiles. What does this speak to?
So I think what's happening is, there's a number of things I think happening in the oil space. Firstly, there is a bit of a structural shortage of oil that is looming on the horizon. This is something that has actually been sort of playing out over the last few months. The impact of the coronavirus pandemic has obviously, drastically reduced oil prices, which created an interesting opportunity, I think, for OPEC to try and squeeze out the US shale gas producers. And we're starting to see some bankruptcies in that space. So there might be a bit of a move to keep the oil price relatively low, but the general sort of structure of the market at the moment is that there haven't been any real new investments into major oil projects. So these are, the big oil rigs. The shale gas producers don't really produce all that much if you compare them to, the offshore oil rigs and that kind of stuff. And there haven't been any major investments into big oil rigs for the last 5 years. So that means that the oil rigs that were invested in 5 years ago are starting to come online now and over the next 2 years. And with the lack of new investment, that means that there could be a supply constraint. So I think that's starting to play out a bit. So it wouldn't be surprising to see the oil price rise considerably over the next couple of years. And further, even though there was a build in stockpiles, there is also a return to normality, if you will. Some of us are still working from home, sure. But, if you have a look at what's happening in China, oil tankers are actually, queuing outside the ports to unload oil as their economic activity is picking up again. So we're seeing a number of different things happening simultaneously. OPEC is cutting oil production to try and stimulate the oil price. To try and keep it relatively stable. Plus, there is a resurgence of demand, and that demand might not necessarily just be from the U.S. at the moment. So, yes, there is a fear that the second wave of coronavirus will probably or could send the U.S. back into sort of a hard lockdown situation and slow down their economy again. But, the rest of the world is kind of waking up and starting to demand a bit of oil again, and that, I think, is underpinning the price at the moment.
Yeah. The biggest stock on the JSE released a trading statement yesterday. Just give us a sense of what those numbers look like.
So the numbers were, I guess kind of mixed. From a process perspective, they actually saw core headline earnings per share increase somewhere between 3.7 and 12.1%. Obviously, they'll give us the exact number once the numbers have been finalized. And from a Naspers perspective, core headline earnings per share was actually down somewhere between 7.7 and 1.2%. So, that does look bad, I guess, on the surface, but a lot of that is due to some fair value adjustments that they'd made. Last year, the fair value adjustments were considerably bigger than they were this year. This year, it came in around $600 million. Last year, it was somewhere closer to $1.5 billion. So that obviously reduces the income that the company earned because those fair value adjustments on unlisted, investments doesn't have such a big impact. Plus, there were, also some disposals, but less than last year. So that is less income as well. And also, at least from Naspers' perspective, before Process was spun out, which is basically all the e-commerce business that they do, 100% of the earnings of Naspers were attributable to of Process were attributable to Naspers. Now it's only around 72.5%. So that reflects lower income coming from Process, and that's why we see a decrease in headline or core headline earnings per share. But otherwise, the rest of the trading statement kind of shows a robust business that working in the e-commerce space and food delivery and stuff, there was some impact on, due to the COVID-19 pandemic. However, from an e-tailing and e-commerce perspective, they actually, didn't do too badly. So I don't think it is, I don't think it really means too much. I don't think it was necessarily a bad set of results. I think it's just an adjustment of, the post-process split.
Petri, it's always a pleasure chatting to you. We're going to have to leave it there for now. Thank you for your time and very thorough analysis there. Trader and founder at Herenya Capital Advisors, Petri Redelinghuys.